Welcome back to EDS, and in this video I'm going to show you how to get a 77% win rate and above through writing options contracts, collecting a premium upfront, and also being able to generate consistent returns year on year as a byproduct. So the first thing you want to do is open up any equity underlying in your brokerage platform. We've got VST open right now, Vistra Corp. It doesn't matter which one you pick. We just want to navigate over to where we can see a list of expiration dates, and we want to lock in on an expiration date that we can choose and use to mock up positions moving forwards. So the one that we choose needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration date. And currently the only one that actually fits that criteria is January 17th, which is 34 days out in time. So the reason why it doesn't matter which equity you choose is because the expiration dates for all equities are basically the same. It starts to vary when you start looking at things like futures, but for equities, it's all the same. So 34 days out in time, that's the information that we need. We can come over to our watch list and filter out any and all underlyings that have earnings over the next 34 days. Now, the reason for this is because we want to filter. We don't want earnings to come along and mess up our position, right? Earnings will increase volatility. It will mess up our deltas, and both of these things will have a negative effect on our P&L. Remember, our P&L is based on the options price, not the price of the underlying. It's a second layer. It's a derivative of the actual underlying itself. We also want to filter out anything that has a low liquidity rating level. The reason for this is simple. We want to be able to get in and out of positions easily, and in order to do that, we need liquid markets. Also, we only want to be trading things that have tight spreads. The spread is what you pay when you get in and when you get out of the position. So the tighter the spread, the less you pay, the more money you make. So what you'll be left with is something that looks like this. This is a pre-made watch list. You can use any watch list that you like. And we want to, or what I personally like to filter or order everything from high to low IVR. IVR is IV rank. It's essentially an indicator that tells you where IV is relative to itself for that specific underlying over the past year. So an IV rank of 100 means that it's the highest that IV has been for that underlying over the past year. It's how we can measure where IV is relative to the underlying's past IV over the last year, if that makes sense. And then we have absolute IV over here, which is different, and I'll show you a little example. So IV rank, right? We have WY with an IV rank of 88.8, mRNA with an IV rank of 85.8. Very similar IV ranks, but if you look at the absolute IV, one is basically 26%, and the other one's practically 81%. So 26% and 81%, but the IV rank is basically the same. How can that be? Well, because mRNA clearly has a higher IV overall, generally speaking. So IV rank can tell you where IV is relative and specifically to that underlying itself, right? If that makes sense. It's because, for example, if you've got a company like Coca-Cola and you've got a company like Tesla, an IV rank of 100 on Coca-Cola is going to be a lot different to an IV rank of Tesla. If Coca-Cola has an an absolute IV of 50%, that's very high. But an absolute IV for Tesla of 50% is normal. It's actually fairly low. Tesla, it's a completely different animal. It's a different beast. And IV rank allows you to measure IV relative to that specific underlying. And volatility is a mean reverting product. So we want to sell premium, write contracts when volatility is high, and then we want to play the contraction back down to the mean and hopefully further below. And IV rank helps us to do that. And that's why I personally like to order it from high to low IVR, but that's not necessary. You don't need to do that. The market is closed today. It's a Saturday, so take these quotes with a pinch of salt. Obviously, the market is going to be different come Monday morning. or Monday afternoon. I'm based in the UK. But we can still mock up positions and show you what it looks like. So at this point, we want to keep in mind what's already in our portfolio. We want to make sure that whatever new positions that we place complements our portfolio well. We want to keep everything nice and diverse. We can get fancy and use beta weighting. We can use a correlation to the SPY. But for most people, as long as you're using common sense, you'll be fine. If you've got a bunch of finance stocks or finance positions, even in your portfolio, maybe don't look at Goldman Sachs, for example. Look at something completely unrelated. Maybe look at something in the health sector. Who knows, right? But use common sense, you'll be fine. So as you go down the list, you want to keep an eye on what IVR is. You want to keep an eye on the size of the underlying as well. An underlying that's too small, for example, AMCR is trading at under $10. Your strike selection is going to be very limited. And it's going to be difficult to actually get on a favorable position. That's not to say you can't trade it. If you want to just sell a cash secured put or something, or just a put in general, or a covered call or something like that, you probably be fine. But if you want to sell strangles and iron condors, it's going to be a bit difficult. So keep in mind the size of the underlying. I generally like to stick to anything that's kind of $40-50 and above. IV rank, you want to keep an eye on that as well. Generally speaking, anything with an IV rank of over 50 can be considered high. However, sometimes some over 30 can be considered high. It just depends on the market. And obviously keep an eye on IV as well, absolute IV. This is more important if you're looking at futures, but we're not going to cover futures because futures uses span margin, but that's beyond the scope of this video. So what we're going to do is just have a look, and I did have a little look prior to recording the video, and I managed to find VST. The logic process was simply WY. It's a little bit too small. mRNA, it's a little bit too small. We had a look at that a couple of days ago. We don't need to look at it again. Tesla, we've already got a position on Tesla. We had a look at that as well. UAL is kind of nice. With an IV rank of 74.9. We didn't go with UAL. I believe we did have a look at that as well over the last couple of days. We've got EXC a little bit too small, DOC a little bit too small, CE. I don't really like it personally. AMCR is a little bit too small. VST is trading at up just under $145. If you have a look at VST, this is what it looks like on the chart. We do not use the chart, guys. We do not look at the chart to base any of our trading decisions. But by all means, if you want to have a look at it, just so you can visually see where price is relative to itself over the past X amount of time, go for it. The one thing that can maybe be useful is if you're looking at the bottom chart here, it shows you where IVR is relative to itself. But other than that, we don't use the chart, guys. So VST, we're just going to navigate over to the let's just go over VST in a little bit more detail. So it's trading at just under $145. Obviously, we've got super wide bid and ask here. This is because obviously the market's closed. So remember, just take these quotes with a pinch of salt. We've got an IV rank of 65.3. Correlation to the SPY of 0.19. So it's not very correlated, which is kind of nice. It is slightly positively correlated though. And an absolute IV level of 56.6, which is kind of nice. So let's just go to the expirations list, and we already know January 17th is where we're going to be. We figured that out at the beginning of the video, and this is now the options chain. So what does all of this mean? So on the left side you have calls, on the right side you have puts. Okay, this horizontal orange bar shows you where the price of VST is with respect to the strikes. The vertical orange bar shows you the expected move of VST over the next 34 days. Now, how can we set ourselves up for a high probability of success, as mentioned in the title of this video? So, the way that we can do that is by selling contracts outside of this expected move. Because if the market expects VST to move within this range, this orange bar, and we sell contracts outside of that expected move, well, then our probability of success is going to be very high because the market doesn't expect it to move beyond this this expected move. We've also got these blue dotted lines here that shows you standard deviation marks. If anybody knows about standard deviations, it's pretty basic stuff. You have 1 standard deviation, 2, 3 standard deviations, so on and so forth. So this blue dotted line here shows you where the 1 standard deviation level is, which if you include both sides, it means that price has a 68% chance of staying within the 1 standard deviation mark. And then you can go out even further beyond 2 standard deviations, but I wouldn't necessarily recommend going that far out unless if you're using futures, because the way that margin is calculated is completely different for futures. But we want to be around the 1 standard deviation mark, which, as you'll notice, is outside of the expected move. That's not a coincidence. And you'll notice it's like this for every single position, every single underlying. The numbers are the numbers, maths is maths. So what we want to do is also we want to have a look at the bid and ask spread. Now, obviously, it is slightly wide, but that is because the market is closed. Come market open, this will tighten up. We're not actually going to send any orders to get filled today. We're just showing you an example of what it looks like. So we also have the delta column here on both sides, on the call and on the put side. Now, we want to stick to anything between a 15 and 20 delta on either side. Okay, we want to sell 1 call and 1 put, and we want to sell them around the 18 delta, which, as you'll notice, the 18 delta on this side is just outside the 1 standard deviation mark, and the 18 delta on the put side is just inside the 1 standard deviation mark. So you should be starting to put a picture together in your head now that, we know where the expected move is, we know where the standard deviation mark is. If we are selling at the 1 standard deviation mark, then we've already automatically got a 68% chance of success, just purely based on standard deviations. We've also got, our deltas reconfirming everything. And essentially what we've done here is we've created a range for ourselves between 125 and 175. Now, what this means is as long as price stays within this range that we've created for ourselves at expiration, which is in 34 days time, we keep 100% of the premium that we collect up front, which is this number here, 4.92. That's $4.92. Each contract controls 100 shares of the underlying, so you multiply this by 100 and you get the max profit of $492. Okay, now we have a 62% probability of profit. What that means is there's a 62% chance of making at least 1 penny on this position at the point of expiration, which is in 34 days time. And if we want to get out of this position at 50% of max profit, which is 50% of this max profit number here, then we have a 79% chance of that happening at some point between now and the next 34 days. This is how we get our very, very high probabilities of success. Now, our broker is going to require just under $1,500 in buying power to open this position. So our max profit is just under 500 and our buying power requirement is just under 1.5k. So we've got a very, very nice return on capital here. As you can see, this is a naked position as well, meaning that there are no long contracts covering our short contracts. Our positions are naked, our contracts are naked. Which means that we have an unlimited loss potential. Now, you might be getting worried about seeing the unlimited loss potential, but it's nothing to worry about as long as we know how to manage risk correctly, which we will go over in a separate video. We have actually got some videos going over that as well already. So, very nice return on capital. Now, for some people, allocating 1.5k in buying power to one position may be a little bit too much. And for most people, it probably will be a little bit too much. So what you can do is simply buy another contract a little bit further out to cover our short position, to cover our short contract. So the 180 the contract at 180 is going to cover our contract at 175. And we could do the same thing on the put side at the 120 to cover our short at 125. Now, what this has done is it's created a $5 spread in between the short and long contract. As you can see, you've got $5 on either side. Now, what that's done is it's capped our loss. We no longer have an unlimited loss potential. We have a defined max loss now. How is our max loss defined? Well, it's defined by the spread in between the two contracts, which is $5, minus the premium that we collect up front, which is $1.23, multiplied by the contract multiplier of 100, and we get our max loss of 377. Now, our broker knows that our max loss is now defined, and so it only needs to hold that much in buying power. So we significantly reduce our buying power requirement. Now, generally speaking, when we cover our shorts, we end up with a higher return on capital than what you typically would get with a naked position. However, because our return on capital was so high on the naked position in the first place, it doesn't really make too much difference. But generally speaking, you do get a higher return on capital. Now, in the market, because everything is priced, in my opinion, very efficiently, you don't get anything for free. So if you have a higher return on capital, you have to give something somewhere. And in this case, we end up with slightly lower probabilities of success, as you can see here. And that is the trade-off. Now, we're not done there because you can still manipulate these positions further. If you want to be more aggressive and collect more premium on entry, you can do so. You can reduce your max loss. Essentially, you're manipulating your risk-reward ratio here. You're collecting more premium up front, and in return, you can play with your probabilities of success. If you would like much higher probabilities of success, you can just go a little bit further out, as demonstrated here. So we're at the 13 delta on the put side, and we're at the 14 delta on the call side. So whenever quoting deltas, we're always looking at the short contract. So as you can see here, we're now back to the higher probabilities of success. We do collect less premium up front, but that's just the nature of the game. And you can manipulate. This is how you find and manipulate positions to fit inside your portfolio. How do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a position sizing template that's free for everybody to use and get a copy of. The link is in the description. Just click on free position sizing template. And the way it works is you enter in the size of your portfolio. Let's say if it's $25,000, and then you enter in the current VIX level. Let's just say if it's 16.1. Everything below will then be automatically calculated for you. And at this point, all you need to do is use this information to form the backbone of your portfolio, and you will be absolutely fine over the long term. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, and how much of your portfolio you should be allocating to short premium strategies in general. There's also an explanation here explaining everything and going into a little bit more detail. Again, like I mentioned, it's free. Link is in the description. If you want to learn in more detail about what we do, how we do it, start to finish, link is in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. So no prior knowledge is required. If you get stuck at any point, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's also a 100% money back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free for you. And right now, the price is £1 a month. The price will be increasing. It's so cheap because we've just launched. But once we've got a couple more people in, we will be increasing the price. However, once you're inside, the price is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to get you self-sufficient within about 6 to 12 months. By all means, you're always welcome to stay and be a part of the community. But the mission for us is to get you to a point where you know how to sell premium, how to manage risk, how to basically do everything yourself and learn the skill within 6 to 12 months so that you can do this again and again for the rest of your life without any external help or influence. That's the mission here. So, with that being said, I will see you guys on the inside.